Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. CoreWeave is, it's really becoming the pure play name in AI GPU cloud infrastructure.
And it's been on a wild ride, to say the least.
Oh, absolutely. The volatility has been just staggering. I mean, the stock dropped 32% from its peak back in November.
32%.
Yeah, and that's what's so interesting because when you look at the fundamentals, they seem, well, superior. So that kind of drop creates what looks like a classic asymmetric opportunity, a huge discount on a really solid story.
Okay, let's unpack this. A 32% drop in the AI space usually screams that something is fundamentally broken. So before we get to why it fell, we have to establish why it should be so high in the first place. What are the numbers that justify calling it a hyper-growth company?
The numbers are, frankly, hard to wrap your head around. We're talking about growth at a massive scale.
Okay.
So in Q3 2025, their quarterly revenue was nearly $1.4 billion.
In one quarter.
In one quarter. And that was 134% growth year over year. This isn't growing from a small base. It's this incredible accelerating curve.
That's already huge, but the market's always looking forward. What are they guiding for the full year?
Well, this is where it gets even crazier. Management's guidance for the full year 2025 is between 5.05 and 5.15 billion.
So what's that in terms of growth?
At the midpoint, that's 174% year-over-year growth. But here's the kicker. They actually revised that guidance upward.
Wait, they raised guidance. By how much?
By $250 million. And they did it while openly admitting they were having supply issues.
So demand is so strong that even with delays, they had to raise their forecast.
Exactly. It tells you the bottleneck isn't finding customers. It's just the physical speed of building things.
Yeah, that growth is just it's almost unbelievable for a company that big. But this is where I get skeptical. Infrastructure plays, especially ones building out this fast, they just burn cash, right? They usually have razor-thin margins. Can they actually be profitable?
That's the beautiful contradiction here. They're achieving profitability years ahead of what anyone would expect. In Q3, adjusted EBITDA shot up to $838 million.
$838 million. So what does that work out to as a margin?
It translates to a 61% adjusted EBITDA margin.
61%.
Yeah.
I mean, that's a mature software company margin, not a fast-growing infrastructure company.
It's absolutely massive. And this is where the stock starts to look incredibly cheap. You see margins like that from, the big hyperscalers, the Amazons and Microsoft.
Right, the ones who've been at it for decades.
Exactly. But CoreWeave is doing it while growing revenue 10 to 15 times faster than them. It's instant scale and instant efficiency. It's pretty remarkable.
Okay, so you've got the hypergrowth, you've got world-class profits. The question then becomes, how sustainable is it? You have giants like Amazon and Microsoft pouring billions into this space. What's CoreWeave's advantage? What's their moat?
Here's where it gets really interesting.
Go on.
Their moat is structural. It's built on scarcity. The entire AI infrastructure market has this massive structural shortage. Some estimates put the annual funding gap at like $500 to $800 billion.
That number is almost unimaginable. But if the need is that great, why aren't the big guys just filling it? They have the money.
Because the bottleneck isn't money. It's not even GPUs, really. NVIDIA is making enough chips.
So what is it?
And it's physical infrastructure. Specifically, it's about getting what are called powered shells and dealing with grid interconnection delays.
Okay, let's pause on that. Those sound like jargon, but they seem critical. What is a powered shell?
Think of it as more than just a warehouse. You need the land, the permits, and most importantly, a massive connection to the power grid. These places use the same amount of power as a small city.
And getting that connection is the hard part.
It's the hardest part. For a traditional player, just getting approval from the utility company to plug in can take 5 to 7 years.
7 years. In tech time, that's an eternity.
It is. And CoreWeave has just proven to be much faster at executing on this. They're nimbler. They are basically selling immediate, reliable access to power and AI-ready real estate. That's the moat.
That makes sense. That's a real physical barrier to entry.
Yeah.
But building all this capacity, how do we know they can fill it? Is the revenue actually locked in?
It absolutely is. And the visibility they have is just one of the most compelling parts of the story. They have a $55.6 billion contracted revenue backlog.
$55.6 billion.
With a B.
With a B. That's years of revenue already on the books. It's like a fortress.
And who are these contracts with? Is it all just one or two big customers?
Well, they started out very concentrated, which was a risk. The cornerstones are a $22.4 billion deal with OpenAI and a $14.2 billion deal with Meta.
The two biggest players in the space. Exactly. But they've been diversifying, and this is key. Now, 60% of that massive backlog is with investment-grade customers.
So like who?
We're talking hyperscalers like Microsoft and major banks like Mizuho. It makes that revenue backlog essentially flawless collateral.
And it sounds like they're moving into completely new areas beyond just tech.
They're expanding aggressively. In Q3, they announced wins with NASA's Jet Propulsion Laboratory, which is a huge deal. And even more strategically, they launched CoreWeave Federal back in October.
Federal. So going after government contracts.
Precisely. The U.S. government and defense sector, that's a market potentially worth over $20 billion a year with very long, stable contracts. It's a massive new runway for growth.
Okay, so the growth is there, the margins are there, the backlog is insane. It all sounds incredibly bullish. Which brings us back to the elephant in the room.
Right.
Why did the stock fall 32%? Let's get into the bear case.
We have to. The sell-off was triggered by one thing. A big cut to their capital expenditure guidance.
How big of a cut?
They took it down from a range of 20 to 23 billion all the way down to 12 to 14 billion. The market saw a guidance cut of that size and just panicked.
A $9 billion CapEx cut. I mean, on its own, that looks like a huge red flag.
It does, but the why is absolutely critical here. It wasn't because demand disappeared. It was entirely due to delays in getting those powered shells from their third-party construction partners.
So they couldn't spend the money as fast as they planned because the buildings weren't ready.
Exactly. It's a timing issue. The revenue just gets pushed out a bit into Q1 2026. The demand is still there waiting, but the market reacted to the headline number, not the reason.
That makes sense, but it still brings up the other big concern. Capital. To spend all this money, they've taken on a ton of debt, something like $18.8 billion. That level of debt scares a lot of investors.
It's high, no question. But you have to understand how that debt is structured. Management made a strategic choice to fund this with debt instead of constantly issuing new stock and diluting shareholders.
So how is it structured? What makes it safe?
It's all secured by those customer contracts. Specifically, they're called take-or-pay contracts.
Okay, define that for us. What does take or pay actually mean?
It means customers like OpenAI and Meta are legally obligated to pay for that reserved computing power for years, whether they actually use every last bit of it or not.
So it's guaranteed revenue.
It's guaranteed minimum revenue. And that guarantee from these huge investment-grade companies is the collateral for the debt. It's not just blind corporate risk. It's project financing backed by real contracted cash flow.
That completely changes the risk profile.
It does. And you can see the lending market getting more comfortable. They've been able to refinance parts of that debt at much lower interest rates recently, which shows growing confidence.
And can they actually afford the interest payments?
Under the bull case, yes. Their projected 2025 EBITDA gives them about 2.5 times interest coverage. So for every dollar they owe in interest, they're generating $2.5 in earnings to cover it. It's manageable.
Okay, so the sell-off looks like a market misunderstanding about timing. Let's bring it back to the stock price now. What does the valuation look like after that 32% drop?
The valuation looks, well, disconnected from the business. The stock is trading at around 8.4 times its 2025 enterprise value to sales.
8.4 times. For a company growing at 174% with 60% margins, that sounds very cheap.
It's shockingly low. You see companies growing at half the speed, trading at 3 times that multiple. It suggests the market is still very skeptical. From a technical standpoint, the stock got deeply oversold and is now building a base. It looks like it's coiling for a potential reversal once the story becomes clearer.
So what does this all mean for someone listening right now? What are the key catalysts to watch for over the next few months that would prove out this bullish thesis?
2 main things. First is their Q4 earnings report, which should be in late January 2026. We need to see if those powered shell delays are getting resolved. Execution is everything right now.
Okay, so watch for an update on construction. What's the second thing?
The second is the expiration of the quiet period for analysts. Once that lifts, you'll see a lot more research coverage from big banks. That often comes with new, high-price targets and can cause the market to re-rate the stock.
So to sum it all up, we're looking at this rare mix of hypergrowth, amazing profitability, and a real physical moat. The big sell-off seems like it was more about a timing error on construction than any real problem with demand. The core story, this massive backlog of contracts, is still completely intact.
That's it. I mean, the thesis really boils down to this. CoreWeave has $55.6 billion in contracted revenue. The question isn't if they'll grow. The real question is whether they can physically build the infrastructure fast enough to keep up with the insatiable demand. That structural constraint is the only thing that matters heading into 2026.
Fantastic analysis. That gives our listeners a lot to chew on and a clear roadmap for monitoring this stock. Don't forget to subscribe, like, and comment underneath to support this show. We'll see you next time.